Hi, my name is Kenny Baker. So you've decided or you're considering adding a swimming pool to your home. One of the first questions that I hear is that, okay, we're thinking about a pool, but we want to figure out how we're going to fund it. And so I wanted to explain all of your options when it comes to answering that question. So there are 4 ways that you can add a pool to your property. And I'm going to go into each one. I'm going to talk about them in detail. I'm going to make some comparisons so that you know exactly what your options are when it comes to funding this new pool. Okay, so the first one is cash. And, cash is pretty simple. Hey, you've got the money and, you can just write a check and that's that. Now, I will tell you that I do have a fair amount of clients that have the ability, don't mind paying cash, and for whatever reason they choose not to. It could be that they have looked at all of their options and they've decided, well, wait a second, you know what, I'm making a really good return on investment with my money in the stock market or in an IRA or a 401k or wherever it's at. And it's like, okay, I think I would rather continue making a nice return on that money and go ahead and choose to finance. So even though you can pay cash, you may or may not want to. And so that does happen quite often. Now the second choice is an unsecured loan. Now an unsecured loan is very similar to, well, a personal loan or a car loan. Generally those are short-term loans. They're higher interest rates. And that's because there's no security to those loans. It's not like there's security against that loan in case someone decided not to repay it. So it is considered a higher risk loan, and that's why you'll see higher interest rates in shorter terms. Some of the things that you'll hear if you were to talk to some of the unsecured people that do this type of financing is that if you have really, really good credit, then you'll get what they consider their best rate in terms. And usually those are 7 to 9% interest rate, and they're 5, 7, maybe 10-year terms. Now, if your credit rate is, let's say it's not perfect, so it just misses their box on what they consider perfect, then you can see rates really all over the board. But more often than not, they're 10, 12, 14, and as high as 17, 18% interest rate. And those are usually 5 to 7-year terms. And, there are reasons why you might want to consider an unsecured loan. Let's say you're in a career or a business where you get big bonuses quarterly or annually or semi-annually, and your end result is that, yeah, you want a swimming pool, maybe it's 30 or 40 grand, whatever the cost is, but you believe that you can just pay that off in short order, so this unsecured loan, hey, could be a perfect situation. Yeah, the interest rate's higher. It does give you a requirement for a pretty high additional debt every month, but at the end of the day, you're going to pay it off in short order. So an unsecured loan can work for some people with those type of situations. Now the third option is a home equity loan. Now there are 2 types of home equity loans. The first is just that, it's a home equity loan. It's a fixed amount with a fixed interest rate and a fixed term. The second one is a home equity line of credit. Now a home equity line of credit is a little different than a home equity loan. The line of credit is, well, let's just give you an example. Let's say you get a line of credit for $50,000 and you decide, well, I only need $30,000 of that line of credit, so now your payment is based on the amount that you've used. Now, both of these equity loans, whether it's a home equity line of credit or a fixed home equity loan, they are based off of the current value of your home the way it is right now. And you can talk to any bank or credit union because they all offer these home equity loans. And here's what you're going to hear if you do talk to them, or when you do talk to them. Okay, we can lend you up to 80% of the value of the current appraised value. What that means is they'll send an appraiser out and the appraiser will say, okay, your house is worth this amount, and then the bank will say, we can lend you 80% of that amount. So let's just use a simple numbers. Let's say the appraisal comes back and your house is worth, as is, $100,000. The bank says, we'll lend you $80,000 less, of course, whatever you owe on your house right now. So if you owe $70,000, then that bank will lend you the difference, and in that situation or that scenario, it's $10,000. So home equity loans can work, and they do work under certain situations. If you've got a lot of equity, then they can certainly work. Now, a home equity loan or line of credit is an additional payment on top of your current mortgage payment. Now, I will tell you that the banks or the credit unions, when doing these home equity loans, they have a pretty tight box on the type of client that they consider when deciding whether or not to offer that home equity loan. And generally, they're looking for really good credit, low debt to income ratios. So they're really looking for, the clients that fit into that box. Okay? So those are the things that you need to know about securing a home equity loan. Now, the fourth option is exactly what I offer. What I do is that I take your existing mortgage loan, I add the cost of the swimming pool, and I roll it all together, and I create a brand new, long-term, low-interest rate loan. Now, the big difference between what I offer and what the banks offer on a home equity loan is that when I order your appraisal, I order it with the contract for the pool that you're wanting to add. So when the appraiser does the appraisal, the appraised value is based on how much your home is going to be worth after you've already added this pool. So it is based on after improved value. Big difference between a home with and without a pool. Now, not only do I base my program on the after improved value, I can go and do go all the way up to 95% of that value. So I'm not limited to the 80% value, and I'm not limited to a value based on the current as-is appraised value. So anyway, these are the details. I wanted to make sure you understood all of your options. If my solution fits into what your situation is, I'm ready to help you. Feel free to call me directly. I can be reached at 239-288-1595. Thank you so much for watching this video, and I hope I've answered all your questions and figuring out your options when funding that new pool.